Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Lewis, and I'm excited to share today's top stories with you. We're starting off with a big one, the latest earnings reports from some of the biggest players in the financial industry. JPMorgan Chase, Bank of America, and Citigroup are just a few of the companies that have released their Q1 earnings, and the results are mixed. While some banks saw significant gains, others struggled with declining revenues and profits. According to JPMorgan Chase's latest earnings call transcript, the company reported net income of $14.6 billion, with an EPS of $5.07 and revenue of $46 billion. This represents a significant increase from last year, but it's worth noting that the results included a one-time gain related to First Republic. Meanwhile, analysts are predicting that the S&P 500's year-over-year earnings growth will come in at around 6.7% for Q1, down from the initial estimate of 11.1% back in November. This decline is largely attributed to the ongoing trade tensions between the U.S. and China, which have had a ripple effect on the global economy. JPMorgan Chase's CEO sounded a cautionary note during the earnings call, stating that the company is preparing for a potential economic downturn. He also emphasized the importance of diversification and risk management in these uncertain times. As we take a closer look at the earnings reports, it's clear that the banking sector is facing significant challenges. From declining interest rates to increasing competition from fintech companies, banks are having to adapt quickly to stay ahead of the curve. But what does this mean for investors? Should you be bullish or bearish on the banking sector? We'll be exploring these questions and more in the coming segments. For now, let's take a step back and look at the bigger picture. The global economy is facing numerous headwinds, from trade tensions to geopolitical uncertainty. As investors, it's essential to stay informed and adapt to changing market conditions. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of real estate, where market trends can be as unpredictable as they are fascinating. Today, we're examining the residential market in Quebec, Canada, where the first quarter of 2025 has brought about some intriguing developments. According to recent data from the Quebec Professional Association of Real Estate Brokers, or CAREB, the residential market is showing signs of resilience and growth in various regions across the province. In some areas, such as Drummondville, residential sales have seen a sharp increase of 33% compared to the same period last year, reaching the second highest level of transactional activity since data was first compiled for this region. However, it's not all positive news. The Saguenay CMA experienced a 3% decline in residential sales during the first quarter, which represents a return to normalcy after an exceptionally strong performance in 2024. Meanwhile, active listings have decreased in several regions, including a 19% drop in the Saguenay CMA and a 14% decrease in Drummondville. Median prices are also on the move, with single-family homes in the Drummondville CMA seeing an 11% increase to $384,500. In the Saguenay CMA, the median price of single-family homes rose by 18% to $330,000. These fluctuations highlight the complexities and regional variations within Quebec's residential market. It's essential to approach these statistics with a nuanced perspective, recognizing both the opportunities and challenges that exist within the market. As we continue to navigate the ever-changing landscape of real estate, it's crucial to stay informed and adapt to the shifting trends and conditions. The CAREB plays a vital role in providing insights and support to real estate professionals and consumers alike, promoting transparency and understanding in the market. By analyzing these quarterly statistics and staying up to date on regional developments, we can better comprehend the intricacies of Quebec's residential market and make more informed decisions. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. As we wrap up today's show, we're going to dive into the world of banking and finance, where the big players are reporting their quarterly earnings. And what a wild ride it's been, folks. Morgan Stanley, Wells Fargo, and JPMorgan Chase have all released their numbers, and there are some interesting takeaways. First off, let's talk about Morgan Stanley. They're topping estimates with earnings of $2.6 per share, beating the expected $2.2. Their revenue also came in higher than anticipated at $17.74 billion. Now, this is largely due to their massive wealth management business, which benefits from high stock market values. But as we all know, the trade tensions are casting a shadow over the entire industry. Analysts will be keeping a close eye on investment banking activity, which might take a hit amidst these uncertainties. Meanwhile, Wells Fargo is also reporting higher earnings, with adjusted EPS of $1.39, up 16% year-over-year. Their revenue fell slightly short of expectations, but their non-interest income rose 1% to $8.65 billion. CEO Charlie Scharf is calling for a timely resolution to the trade disputes, emphasizing the need for fair trade practices while acknowledging the risks associated with these actions. Now, let's not forget JPMorgan Chase, where stock traders had a record haul in the first quarter, thanks to the chaotic market moves triggered by President Trump's policy announcement. Their equities markets revenue jumped 48% to $3.81 billion, exceeding analyst expectations. Morgan Stanley's stock traders also delivered impressive results, with revenue of $4.13 billion from equities traded. As we analyze these numbers, it's clear that the banking sector is navigating a complex landscape. While there are certainly challenges ahead, these institutions have demonstrated resilience and adaptability. However, as investors, we must remain cautious and keep a watchful eye on the markets. So, what can we take away from today's earnings reports? Firstly, it's essential to stay informed about the trade tensions and their potential impact on the economy. Secondly, diversification is key. Spread your investments across various asset classes to minimize risk. And finally, always keep a long-term perspective in mind. Avoid making impulsive decisions based on short-term market fluctuation. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, invest with caution.